Hi everybody, welcome back to my deep dive into Rivian. This is part 7. In part 6 we ended discussing credit revenues. Let's jump now to the next big segment. This is services and other, and just to recap what service and other contains. The primary driver is used vehicle sales, also revenue from vehicle repair and vehicle maintenance, charging revenue. So Rivian also owns some chargers, and whenever people charge there, they make a little bit of revenue, but this will be a minuscule revenue stream for Rivian, so barely worth mentioning. There's some software subscription revenue Rivian receives from owners, similar to Tesla. And I'm not talking about FSD, and then there are other services included. There's also an insurance program that Rivian is running in association with an insurance company, and there is also some revenue Rivian extracts from financing. So this modeling of this segment was significantly based on key lessons we learned from Tesla's services and other segment. Because if you look at the items that are included, they're very similar to Tesla. So the composition is very similar, just of course a very different scale. And what you, for example, one key takeaway in Tesla's S&O segment development is that segment consistently grew quarter by quarter. And the reason is very simple. As you keep selling cars, your vehicle fleet keeps growing. So the number of vehicles that potentially need, service, repairs, etc., keeps growing, and that's why it's only natural that revenue just consecutively keeps growing. And actually, here on this chart, you can see the development of Rivian's global, or I should say, North America vehicle fleet. Rivian closed 2024 at 123,000 vehicles, and over the forecast horizon, so next 3 years, that fleet is almost quadruples, which represents the primary driver of, and you can see the totals down here, the primary driver of the full year 2024 revenue, 365 million to almost 1.5 billion increase in 2027. Overall, just like in Tesla's case, it adds to the revenue line, but because of its typically low margin nature, is not a primary driver of the business. Then we come to the last revenue driver. This is the VW JV, so the VW group announced in June 2024 the intention to form a JV, and said they need to confirm certain technical details before they can finalize the deal. Then in November 2024, it was announced that the deal was finalized. With that, it was also announced that the initially planned roughly 5 billion of VW Group investment was increased to 5.8 billion, so roughly 800 million, let's call it 800 million increase. And when you look at the financial modeling of Rivian, I think you see kind of why it was increased, because Rivian is still weakly capitalized, and Rivian is of no use to VW if the company gets into trouble. So they want to make sure they stay on they are on sort of solid footing, at least for the next few years, because also VW has now a significant stake in Rivian equity, and they're also not keen on seeing too much dilution in that stake. However, as you can see in these numbers, it's still highly likely that Rivian, at least in 2026, has to raise more equity. But yet again, VW also doesn't have infinite access to capital, and they're also somewhat limited, because VW Group is paying a dividend, and cash flow is very low, so they are also in kind of a pickle. Important note in terms of this revenue stream. So the CFO said that the disclosed 1.96 billion in deferred revenue will be distributed over an approximate 4-year time frame, and this revenue release was back-end loaded. So let's just decompose what that means. So 4 years, there would be 16 quarters, and back-end loaded means that the majority would probably take place in the second half. And they also said we should expect to kind of ramp up. So the forecast is actually a lot more aggressive on this, and makes two significant changes. One, the forecast assumes the full deferred revenue is released over a 3-year period, so 12 quarters. This means you see the effect of the full release fully within the forecast time period, because the forecast, as you can see, is for 12 quarters. The forecast also includes what's called a sweetener. Often in these deals, I worked a bunch of these in my career, there is, people call it sweetener. It's basically a clause that says, or I should say an incentive, for the partner to basically try to give their best effort to earn that incentive. It's literally just like a bonus. Just like when you incentivize an employee, you pay them a base salary, but because you want to extract maximum performance, you put this carrot in front of them. The exact same strategy is applied to these business deals, where companies say, okay, please deliver these performance milestones, but if you outperform these milestones, we give you extra. And in VW's case, they have a huge interest in getting the EE architecture from Rivian incorporated in their vehicles ASAP, and given the accelerating vehicle timeframes which are driven by the competition from China, I think this was, to be honest, BS from the CFO. She just was sandbagging this point, because I don't think VW said, oh, okay, let's have something in 4 years. No, we want something over a meaningful time frame, and even 3 years might still not be aggressive enough, to be honest with you, given the situation everyone in the auto industry is in right now. But that's why I feel quite comfortable accelerating this guidance. So yet again, the forecast in this point at least meaningfully exceeds what Rivian guided towards. So now we covered all the revenue items, and now we jump to cost of revenue. So here right now you see the total cost of revenue. This number on its own is completely pointless, as every analyst will tell you, because you need to look at this in terms of margins, etc. But I'm just showing you the development. This is kind of meaningless. This is more interesting. Now we've split it down into the main segments. So, but as you would expect, the vast majority of cost of revenue is situated in the automotive segment, and with an increasing amount in the software and service. But keep in mind, all the VW JV related cost is booked in R&D, which is down here, in operating expenses, not in cost of revenue. That's kind of the key point here. So the cost increase that you see here in the service and other segment, software and services segment, is really all, as it's stated here, services and other, not the overall big segment. Again, service and other is a sub-segment of the main segment, software and services, but it's all driven by service and other. So this means all the Rivian service infrastructure. I'm sorry, not service infrastructure. Sorry, I'm talking rubbish here. That cost is driven by running and operating the service infrastructure. That's the correct way of putting it. This does not include any investment in the service infrastructure except for the depreciation charge. So next slide, let's dive into automotive cost of revenue. Here again, this number is yet again kind of irrelevant without putting it into perspective. I'm just showing you here the development. This also reflects like variations in depending on seasonality, etc., vehicle delivery volumes. And then you see here, finally, the interesting bit. But because this part 7 already got kind of long, I stop here, and we'll dive in. We will start part 8 from this slide. Thanks for listening. See you in the next one. Bye.